Amazon reported earnings, and the stock dropped roughly 10% after the release. At first glance, that reaction looks extreme, because the reported numbers were mostly solid. Revenue came in at $213.39 billion, beating expectations of about $211.5 billion. AWS revenue was $35.58 billion, also ahead of estimates. Total operating income was $24.98 billion, slightly above expectations. Earnings per share were $1.95, just 1 cent below estimates. So this was not a blow-up quarter. The sell-off wasn't about what Amazon just did. It was about what Amazon said comes next. The first issue was guidance. For the upcoming quarter, Amazon guided operating income to a range of $16.5 to $21.5 billion. The market was expecting closer to $22 billion. That gap matters. When a company this large guides below expectations on profitability, even after a decent quarter, it forces investors to reassess near-term earnings power. And that brings us to the real driver of the sell-off: spending. Amazon is in a heavy investment phase. Management made it clear they are continuing to spend aggressively, particularly in AWS. That includes more data centers, more compute capacity, more networking, and more infrastructure to support AI workloads. From Amazon's perspective, the logic is straightforward. Demand is there, and they want to install capacity as fast as customers can consume it. But from the market's perspective, that spending delays margin expansion and pressures free cash flow. So even though AWS revenue beat expectations, investors focused on the cost required to sustain that growth. That tension is showing up directly in guidance. The second factor is that AWS, while growing well, is now so large that every percentage point of growth requires enormous capital. $35.58 billion in quarterly AWS revenue is a massive base. Growing that business at a mid-20s rate means Amazon has to keep pouring money into infrastructure just to keep up. Again, that's a long-term positive, but a short-term valuation headwind. The third issue is operating leverage. Total operating income beat expectations this quarter, but forward guidance suggests that leverage is not improving in the near term. Investors were hoping that scale, especially in AWS and advertising, would begin translating into clearer margin expansion. Instead, Amazon is signaling that it is choosing growth and capacity over near-term profit optimization. There's also an expectations reset happening around earnings quality. Even though operating income came in above estimates this quarter, earnings per share were slightly below expectations. That reinforces the idea that incremental revenue is being absorbed by higher costs. Now, it's important to be clear about what this sell-off is not. This is not about weakening demand. Revenue beat expectations. AWS revenue beat expectations. Advertising remains strong. Nothing in the reported numbers suggests the business is slowing down. This is a market reaction to timing. Specifically, the timing of when spending turns into free cash flow and margin expansion. Investors are essentially being told, this investment cycle is not ending soon. That's why the guidance mattered more than the quarter itself. Now let's talk about what keeps the long-term story intact. First, AWS performance. $35.58 billion in quarterly revenue, above expectations, confirms that cloud demand remains strong. Amazon is not losing relevance in cloud. If anything, it's leaning harder into it. Second, operating income is still substantial. Nearly $25 billion in operating income in a single quarter is not a sign of a struggling company. It shows Amazon has the earnings power to fund its own growth without relying on external financing. Third, advertising continues to scale quietly in the background. While not broken out in the image, ad revenue is a meaningful contributor to operating income and remains one of Amazon's highest margin businesses. That provides some offset to capital-heavy areas, like fulfillment and cloud infrastructure. So the takeaway is simple. Amazon didn't sell off because the quarter disappointed. It sold off because guidance confirmed that spending remains elevated, margins will stay under pressure in the near term, and earnings growth may lag revenue growth for a while longer. The market adjusted the stock to reflect that reality. From here, the key questions are straightforward. Does AWS continue to beat expectations? Does operating income begin trending toward the upper end of guidance ranges instead of the lower end? And does Amazon eventually show that this spending cycle translates into stronger free cash flow? If the answers are yes, this pullback will likely be viewed as a temporary reset. If not, investors will continue to demand patience and possibly a lower multiple while Amazon builds. That's what this earnings report really changed.